It's, um, right, thank you. So today I want us to start with IFRS 13. That is fair value measurement, and this short standard and a simple standard. Then I think we can move on to IFRS 80, then IES 8. They are just short and simple standards. So they are all performance standards. So I said before we treat financial instruments, I want us to take a look at this fair value measurement because we've been seeing this fair value. So how do you determine the fair value? Okay, how do you determine the fair value? So we are saying the standard defines fair value as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay. And we are saying these market participants are knowledgeable and third parties. So the knowledgeable there is just to tell us that these market participants know what they are dealing with. Okay. They are knowledgeable in that particular market. When pricing an asset or a liability, they take into account. So before they will put value on a particular asset or a liability, they will consider the location of that asset. Okay. And also they will check the condition and also the restrictions on that particular asset. Okay. And we are saying that these market participants, they are not forced into what? Transactions. Okay. They are not forced into transactions. They enter into this particular transaction willingly. That's why we are saying that these market participants are not experiencing cash flow difficulties. Okay, so they have enough cash flow. It's not like someone is forcing them to enter into that particular transaction or something like that. They know what they are doing. So basically, as I said, no one is going to ask you what is fair value and all that, but just for knowledge sake, the price that will be received to sell an asset, okay, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. All right. Now you are saying according to the standard, we have different methods for finding this fair value we've been talking about. And for the purpose of this course, we are limited to just three. So we are saying we have market approach, cost approach, and what? Income approach. And the market approach, we are saying these valuations are based on recent sales prices. Okay, so the recent sale price of that particular asset, the recent ones are the market approaches. Then we have cost approaches, so valuations based on replacement costs. And income approaches, so valuations based on what? Financial forecasts. We are saying that regardless of the methods that you are going to use, estimating the price that will be transferred in a transaction with a market participant is the same goal. Okay, so yeah, just trying to tell us that oh, this one is favorable, maybe this approach is favorable than all of this. No, they all result in the same word goal. Okay, so this is the scope. We are saying does not apply to these standards because we have standards for these areas. So that is the scope. Now we have exit price and what? Entry price. What is this exit price? We are saying is the price that will be received to sell an asset or paid to transfer a liability. So you just use the name. If you forget the meaning, just use the name exit. Okay, that means it is going out. Okay, then entry, just entering. So if it's for the asset, you are disposing of your asset, the price that you receive. Okay, or maybe you want to transfer a liability. Maybe you are settling your liability, so you are transferring the liability from your books. So that is the exit price. The entry is the price paid to acquire an asset. So if you are purchasing an asset, the price that you pay to purchase that particular asset is the entry price, or to assume a liability in an exchange transaction. Now, how do you determine this price that we are talking about? Okay, that we are talking about. We are saying that the fair value here is a market-based measurement. So the fair value we are talking about is what found on the market, not an entity specific. So we can't say that, oh, this is my fair value. The fair value should be on the market. That's why we are saying it's a market-based measurement. Okay. As such, when determining the price at which an asset would be sold or the price paid to transfer the liability, observable data from active markets should be used. So we are going to discuss this observable data. And what do we mean by what? Active market. We are saying that active market is a market in which transactions for the asset or liability take place frequently. Okay, so active, the word active, oh, you are active, you are this, it means every time you are available. So we are saying this active market is a market in which transaction for the asset or liability take place frequently. It's not like a dominant market or something like that. So this one is always active. People are buying, people are selling all the time. Okay. So the standard group's valuation techniques input into 3 levels, okay, to determine the price, this fair value that we've been talking about. The price that you are going to choose, we are saying that the standard group these techniques into 3 levels, and we call them the inputs, okay, the valuation technique input. All right, so the level 1, we are saying is what? Quoted prices for identical assets in active market. So it's not anything difficult. If you hear level 1, just try and memorize this one, because we are saying this one is what? A quoted price for identical asset in an active market. Now I want to make this one open. Okay, let's all discuss. So what is the difference between identical and similar? I want to see something. Let's discuss. This one is to the class. Let's discuss what is the difference between identical and what? Similar. So you use identical asset and similar asset, and you can give what? Examples. All right.
Identical is literally the same, but similar have some one features that are just off, but identical is the same thing.
Oh, okay. So do we all agree with her? So maybe examples. Can you give example? Maybe car or phones or something.
So we have identical twins; they look the same, but
Okay.
similar. Similar. We can have iPhone 16 and iPhone 17. They have the same features, but they're not the same.
Okay. Thank you very much. So the level 1 is what? Quoted prices for identical assets. All right. Level 2, we are saying that these are observable prices that are not level 1 inputs. Okay, so the observable prices on the market that are not what? Level 1 input, and we've already determined what level 1 inputs are. So outside level 1 input is what we are talking about. So we are saying A, quoted prices for similar assets or a liability in active market. So the first one is what? Quoted prices for similar assets or a liability in active market. B, quoted price for identical assets, but this time around in inactive market, because the quoted prices for identical assets or liabilities in active market is what? Level 1. So outside level 2, then we will have what? Quoted price for identical assets this time around in inactive market. And C, we are seeing observable inputs that are not what? Prices. Okay, that are not prices, such as interest rate and all that. Now level 3 is observable input for the asset or liability. So mostly the level 3 is what? Sometimes entity specific, because the management will do some forecasts. Okay, we just do some projections. So that is the level 3, and we are saying that priority is given to what? The level 1 input. Level 3 are assigned or the lowest priority. So when you get a question, you ask yourself if the price is what level 1, the input, which one are you choosing? So you are saying priority is given to level 1 before you come to level 2 and what level 3. All right, before you come to level 2 and level 3. So basically this is short standard. I think we are okay as at now. So we are going to read this illustration. Then when we are done, we'll come to what the type of markets. Okay, this one we are just looking at the prices, but we are discussing what active market. So we will come to the types of markets. All right. So what we just discussed here is the prices, or how you are going to figure out the price on the market. Okay, price on the market. Because we are saying this fair value is not entity specific, is market based. All right, market based measurement. That's why we are saying priority is given to level 1. Because the level 3, that one is what? A projection from what? The company. So do you have any question? Hello, do you have any question for me?
No, please.
Okay.
No, please.
So I think this one is quite simple standard. So please let's read the illustration one. Someone should read for me.
I beg again today someone should take over. I'm coughing, so my voice is not that good.
Genuine Limited has an investment property that is measured at fair value. This property is rented out on short-term leases. The directors wish to fair value the property by estimating the present value of net cash flows that the property will generate for Genuine Limited. They argue that this best reflects the way in which the buildings will generate economic benefits for Genuine. The building is unique, although there have been many sales of similar buildings in the local area. Required to discuss whether the valuation technique suggested by the directors complies with the IFRS.
Okay. So please, we just finished the standard reading or discussing the previous input. So please, do you agree with the directors, or we have some different ideas on this? Mm-hmm. Oh,
We are diagnosing it.
okay, okay. One minute is enough. Let's stop. Let's stop. So let me give you a clue. That directors wish to fair value the property by estimating the present value of net cash flows that the property will generate for Ginyami Limited. So what level is this one?
Level 1.
Okay, he's saying level 1. So please, who is having a different idea? Hello. Mangasa yonkoyo. Oh, so it means what we discussed, you didn't understand. Class. I even said the level 3. They are what? The entity specific one, because that one is what? Management projection. So this one, the directors wish to fair value the property by estimating the present value of net cash flows that the property will generate for Jinyami. So this one is projection. Okay, so this one is level 3 input. But we are saying that priority should be given to what? Level 1. Then we come to level 2. The list should be level 3. So in this case, you ask yourself, are we having level 1 input in here? No, we don't have quoted prices for identical assets in active markets. Okay, let's come to level 2. Now we are saying that the building is unique, although there have been many sales of similar buildings in the local area. So yes, we have level 2 input here. Okay, now he said priority should be given to level 1, 2, then the list is 3. So if you don't have level 1, you don't have level 2, then you can use their what projections. But here we have level 2, so you choose the level 2. So let's look at the answer. We are saying that the director's estimate of the future net cash flows that the building will generate is a level 3 input. IFRS 13 gives the lowest priority to level 3 input. This should not be used if level 1 or level 2 input exists. I've said this one. Observable data about the recent sales of similar properties is a level 2 input. Therefore, the fair value of the building should be based on these prices. That is the level 2, with adjustment made as necessary to reflect the specific location and condition of Jinyami Limited's building. So please, is it okay? Always when you see it, ask yourself, are we having level 1 input? If yes, you just pick it. If no, you come to level 2. If you don't have level 2, then the list should be level 3. And now, as I said, the level 3 house entity specific, because that one is what? Manager's projection. And that one, you see that they will use the present value. Okay, and we know present value is what? Discounting future values or amount we are yet to receive in future. Okay, so that is what you should do. So please, is the solution to this particular illustration okay, or you need more clarification?
Another illustration have been good. Let's have one.
Mm.
If
Okay,
there's
so going forward, we will look at it.
okay, all right.
So we are saying if you have level 2 inputs, okay, and there is a significant adjustment, that one can lead to what? A level 3 input. Okay, so if you look at this particular illustration, although we are using the level 2 input, okay, but we are saying that you should make adjustments necessary to reflect the specific location and condition of what? Jinyami, the building that they are having. Okay, you should make necessary adjustments. So although we are using level 2, but with this necessary adjustment, it can lead to what? Level 3 input. All right. So as you said, you'll be having questions after this topic so that we discuss. All right. So as I said, let's look at the markets, right? The types of markets. Now we are saying the price received when an asset is sold or paid when a liability is transferred may differ depending on the specific market where the transaction occurs. Okay, so the price you receive when you sell your asset, that's the entry price. okay, or when you pay to settle what your liability, when that means you are transferring the liability, may differ depending on what the type of market where the transaction occurs. All right, and we are saying according to the standard, we are having two types of markets. The first one is what? Principal market, and the second one is what? Most advantageous market. Now, what is this specific principal market? We'll come to that, but we are saying the standard tells us that, oh, before you use advantageous market, make sure that there is no principal market, because always priority is given to what? The principal market. That's why, according to the standard, the principal market shall be used as a reference when measuring the fair value. So for you to come up of determine the fair value, you have to make reference to what? The principal market. If there is no principal market, just use what? The advantageous market, the most advantageous market. Now, what is the principal market? We are saying the principal market is the market with the greatest volume and level of activity for the asset or a liability. So it's the market with the greatest unit of that particular asset. So if you are dealing in, let's say, a vehicle, the market that is having the greatest number, okay, if market 1 is having 1,000 vehicles, market 2 is having, let's say, 800 vehicles, the 1,000, okay, the market where we can see the 1,000 vehicles is market 1. That becomes what? The principal market. Or what I'm trying to say, that if you have market 1, you have market 2. Now, the volume or the number of units for market 1 is, let's say, 1,000 vehicles. Then market 2 is what? Let's say 800. The principal market is that the market that is with what? The greatest volume and level of activity. Therefore, market 1 becomes the principal market. Okay. If you don't have market 1, if you don't have principal market, then you move on to what? Market 2. That one is it will be probably the most advantageous market. So when a question is given, okay, they will attach units. They will give you a number of units in that particular market. I mean, the asset you are dealing with can be vehicle, like any asset. They will give you the unit or the level of activity. So the one with the greatest volume will be the principal market. Okay, the one with the greatest volume will be the principal market. That's what I'm saying here with this particular illustration. Market 1 is the principal market, and IFRS 13 is saying that always to come up with the fair value, make reference to what? The principal market. Make reference to the principal market. So please, is the principal market okay?
Yes, for me.
Okay. All right, so let's move on to the most advantageous. I think the most advantageous market is the market that maximizes the amount that will be received to sell the asset, or minimizes the amount that will be paid to transfer the liability after taking into account transaction costs and transport costs. So we come to this transaction costs and transport costs. Now, the second type is what? The most advantageous market. And we are saying this market is the one that will maximize the amount you receive or minimize the amount you will pay. Because if you are entering the market, okay, let's say you are selling your assets, you probably want the what? Best price for your assets, okay? So you want to receive the highest price. And if you are paying a liability or you are settling an obligation, you want to pay what? The least one. So if it's an asset and you are selling, you want to receive the highest price. But if you are paying to transfer liability, you want to pay the least one. And we are saying the most advantageous market is the one that maximizes the amount that will be received to sell and minimize the amount that will be paid to transfer the liability. And to get this one, we are saying that you take into account transaction costs and transport costs. Now, what is this transaction cost? We are saying that transaction costs, such as legal or broker fees. So this one, sometimes you need brokers, okay? So there are fees. Sometimes you need some legal person or something. So the fees that you pay is transaction costs. Okay? And we are saying transaction costs are not characteristics of what? An asset or a liability. Rather, they are specific to a transaction. So transaction cost is not related to the asset, but it's related to what? The transaction. They are specific to a transaction. Okay, they are specific to a transaction. So this, you are saying that the price in the principal or most advantageous market used to measure the fair value of the asset or a liability shall not be adjusted for transaction costs. Now, let's get this one clear. You use the transaction cost or you consider transaction cost to determine which market is the most advantageous, maybe in the absence of what? Principal market. You use transaction cost to determine which market is what? The most advantageous cost. So transaction cost, you have to subtract from whatever you will be receiving. So the net amount is what you are looking at. So you take into consideration the transaction cost when you are determining the maximum amount you want to receive or determine the least amount you want to pay. That one you consider the transaction cost. But if you are determining the fair value or you are measuring the fair value under this most advantageous cost, advantageous market, you are not going to consider transaction cost. You rather consider what? Transport cost. Again, if you are measuring the fair value, you are not going to consider transaction cost, but you consider transport cost. But you consider transaction cost when determining which market is the most advantageous. So please, is the explanation okay?
Please come again, please.
Okay. So all what I'm trying to say is that with the most advantageous market, okay, if you are disposing of your asset, you want to get the highest amount. That's why we are saying that maximizes the amount that will be received to sell the asset. If it is a liability, you want to pay the least amount. So we are saying minimizes the amount that will be paid to transfer liability. Now, you have to determine which market is what? The most advantageous. Okay. Now, with the principal market, we've already established that to determine which market is the principal, we are saying that one is what? The market with the greatest volume. But with the most advantageous one, how do you determine if market B or market C is what? The most advantageous? That one, you consider your transaction cost and transport costs. So mostly you have these two costs, transaction cost and transport cost. You deduct these two costs from whatever amount you'll be receiving if you are selling, or whatever amount you'll be paying if you pay if you are settling an obligation. Okay, so mostly it will be like you are selling the asset. So the amount that you receive, less transaction costs, less transport costs. Then let's say for market D, market E, the amount you want to you receive is, let's say, 50. Okay. Now, the transport cost for market D is, let's say, 10. The transaction cost is, let's say, 8. For this one, okay, so this one, let me do it, transport. This one is transaction. Then this one will be amount received or something, yeah. We have an example, but this one I just want to illustrate. So this one too, let's say the transport cost is what? Okay, so this one is 9. So your net amount received. So what will be the net amount received for D? Yes, please calculate it for me.
32.
32. What about E?
29.
29. Now, I said in determining which market is the most advantageous, you consider what? Transaction cost. So you see, we subtracted 9 from the amount received to get what? The 29. So here, the 32 is the maximum amount we can receive in these two markets. Therefore, market D is the most advantageous market, because to arrive at the 32, we considered the transaction cost 8 here and 9 in market E. But when you are measuring the fair value, so now you've established that, oh, market D is the most advantageous market. So let's look at the fair value with this market. So the fair value, you will not consider transaction cost, because transaction cost is not what characteristics of what the asset or liability. That one is specific to the transaction. Okay, without the transaction, there is no transaction cost. Okay, but the transport is with what? The asset. So the fair value from the D here, because the D is the most advantageous market, that gives what the highest amount. So that one is the amount received less the transport cost of 10. So our fair value here will be 40. So when determining the fair value under most advantageous market, we do not consider transaction cost, but you just consider the transaction cost to determine which market is the most advantageous. So please, is it okay? Hello.
Yes, to me it's fine.
Yes, I'm fine now.
Okay. So we are saying the transport cost, if a location is characteristics of the asset, the price in the principal or most advantageous market is adjusted for the cost that will be incurred to transport the asset from its current location to the market. Okay, so that's why I'm saying if you are determining the fair value under principal market or most advantageous, you will not consider the transaction costs. Okay, so we have this illustration. We have this illustration. So please, let's look at illustration 2. Someone should read for me. I'm waiting on.
I hear me.
Yes.
An asset is sold in two different active markets at different prices. An entity enters into transaction in both markets and can assess the price in those markets for the asset at the measurement date as follows. Market 1, Market 2. Prices, transaction cost, transport cost, net price received. What is the fair value of the asset if A, Market 1 is the principal market for the asset? B, no principal market can be determined.
Okay. So we are saying if you have no principal market, just use the most advantageous market, right? Just use the most advantageous market. So please, we are saying this one, they just told you that, oh, market 1 is the principal market. Okay, so that means market 1 is the market with what? Greatest volume or and level of activity. Okay, of that particular asset. So the unit didn't come, but they are telling us we should assume market 1 is the principal market. So with this one, who can tell me the fair value?
The fair
So with
value.
market 1, what would be the fair value for this question if market 1 is the principal market? So if market 1 is principal market,
So the first value will be the 21.
the fair value will be 21.
I think the fair value is 24.
Okay, so we have 24 and we have 21. Yes.
I think it will be 24.
We are having 24 2 here.
24.
Okay, so we have 3. I need one person, last person. Is it 24 or 21? So you tell me the reason why you are choosing 24. Okay, I think 4 replies are okay. So please, those saying 24, I remember you all. So please tell me why you are saying 24. And the one who chose 21, OJ, you tell me why. Okay. This one is very important to this standard.
So you said advantageous markets. We should consider the transport, not the transaction. So let's say we are canceling out the transaction. So it's just 23 less 2. That will give us 24. That's why I chose 25. I don't know.
So you said you mean 26 less 2, right?
Yes.
Okay. And so OJ, you said 21.
Yeah, so I was thinking that because we said the principal market is the market with the highest volume of activities, and they are saying that market 1 is a principal market. So I was thinking if we are looking for the principal market, then the market 1 will be because of the indication.
I answered advantageous market too. I am now seeing the question.
So I was about to ask you that. Is it principal?
Me laptop are saying
Kafra. Yeah,
I'm using my phone, so my mind is divided. Sorry. I'm now seeing it.
Your answer is correct, just that you brought advantageous in place of principal. So OJ, you are saying that the transaction cost in principal market, you are not going to consider it at all. In all the markets, you are not going to consider it. But in the most advantageous, you use the transaction cost to determine which market is the most advantageous. So in principal market there, you ignore transaction costs because transaction costs are not asset specific, they are transaction specific. So the fair value for A, if market 1 is the principal, will be the price minus transport costs. Okay, so the fair value will be 26 minus 2, and that one will give you what? 24. OJ, are you okay here?
Yes, please.
Okay, so now let's go to B. We are saying B, no principal market can be determined. And if no principal market can be determined, then you have no option than to use what? Most advantageous market. Now, the most advantageous market, we are saying that with this one, although transaction cost is what? Transaction specific, they are not characteristics of the asset. So you consider transaction cost to determine which of the two markets is what? Most advantageous. So please, market 1 and market 2, what will be the most advantageous market? To the class, please.
Okay.
Market 2. Okay, someone say market 2. Do you agree or you have opposing or different ideas?
I second.
Okay. Mhm. Okay. So let's go back to the definition of the most advantageous market. We are saying is the market that maximizes the amount that will be received to sell an asset. So with this illustration, which one is having the highest net price received? 22. 22 is on market 2. Therefore, market 2 is the most advantageous. How did we arrive at what market 2? We considered what? Transaction costs. So transaction costs will be considered to determine which market is what the most advantageous. That one, the job is done for what? Transaction cost. Then you come to how you determine the fair value or how you are going to measure the fair value. The fair value in this market will be the price 25 minus the transport cost 2. So here the fair value will be what? 23. So okay, do you get me now? So the transaction cost there in measuring the fair value, you are not going to consider it in either principal market or most advantageous market. But when you get to the most advantageous market, you will use it to determine which market is what the most advantageous. Then, when you are measuring the fair value, you will not consider or you not account for this transaction cost. You only deal with the price and the transport cost. So please, OJ, is it okay?
Yeah, I'm okay.
Okay, so please, uh, is the question okay for the class? All right, I think we can move on. Now, we have the fair value for non-financial assets. Okay, non-financial assets. So how do you determine the fair value of non-financial assets? We call something highest and best use. Okay, highest and best use. Now, we all know financial assets. We all know non-financial assets. Okay, so the financial asset is what we are talking about. Okay, so this is the definition of highest and best use. We are saying that is the use of a non-financial asset by market participants that would maximize the value of the asset or the group of assets and liabilities. Example, a business within which the asset will be used unless there is proof to the contrary. It is reasonable to presume that the current use of non-financial asset is the highest and best use. This must take into account the use of the asset. That is what PLF. So physically possible, legally permissible, and what financially feasible. Okay. So we are saying that unless there's what a proof or unless you have evidence, we assume that the highest and best use of a non-financial asset is what its current use. Its current use. Now, we are saying the current use of land is presumed to be its highest and best use unless market or other factors suggest a different use. So unless you have maybe a proof that shows that the highest and best use is something else, we assume that is what the use of the asset, the use of the land, or maybe any other non-financial asset. Now, let's look at this physically possible, legally permissible, and what financially feasible. So we are saying a use that is physically possible takes into account the physical characteristics of the what asset that market participants will take into account when pricing the assets. So when they want to price a certain land, the physically possible, these market participants will consider the location of the land, will consider the size of the land. Okay, so the physical aspect of it, they will consider that one before maybe they give or they determine the fair value of this particular land. All right, please, I hope the physically possible is okay. Hello.
Please come again.
So we are saying the physically possible, a use that is physically possible takes into account the physical characteristics of the asset that market participants will take into consideration or will take into account when pricing the asset. Now we are saying that before the market participants will price that particular asset or the asset in question, first of all, they will consider the physical characteristics. And we are saying example is what? If we are talking about land, it's a non-financial asset. So that one, we can have the location of the land, where the land is located. That's a key factor in determining the price. Okay. Size of the land and any other physical characteristics. Okay. So please, are you okay? Maybe they want to see if that place where the land is located, is it a waterlogged area or is it a place that is fine for construction and all that. They will determine all this before the market participants would price that particular asset. So that is a physically possible. Now, a use that is legally permissible. Someone talking, hello. Okay, so a use that is legally permissible takes into account any legal restrictions on the use of the assets that market participants will take into consideration when pricing the asset. So, with the legally permissible, do we have any restrictions on the land? Okay, do we have any restrictions? Do we have any zoning regulations? Okay, are we having regulations? Are we having restrictions on the land and all that? And that is also a key factor in determining the price of that non-financial asset. A use that is financially feasible takes into account whether the use of the assets that is physically possible and legally permissible. So the combination of A and B, okay, the use of the assets, I mean the physical aspect and the legal aspect, generate adequate income or cash inflows, taking into the account the cost of converting the asset to that use to produce an investment return that market participants will require from an investment in that asset put to that use. Okay, so all these readings, or they are just words. They are just trying to tell us that the asset that is physically possible and legally possible, that particular asset, is it going to provide or generate adequate income or cash flows? Because yes, every organization, every business invests for profit. Now, being also invest in Saboka. So they will ask whether the physical characteristics and also some of the legal restrictions or maybe the legal aspect they will take into consideration. This current asset, let's say it's land, okay, is it going to generate adequate income for the business? So this is what they consider physically permissible, physically possible, legally permissible, and what financially feasible. All right, so this one is not anything difficult. All right, so we have a question here on this highest and best use. So please, let's read illustration 3. Let's read illustration 3. Hello.
During a limited acquired a plot of land developed for industrial use as a factory. A factory with similar facilities and access has been recently sold for 50 million. Similar sites nearby have recently been developed for residential use as sites for high-rise apartment buildings. G&M Limited determines that the land could be developed as a site for residential use at a cost of 10 million to cover demolition of the factory and legal costs associated with the change of use. The plot of land would then be worth 62 million. The highest and the best of the land will be determined by comparing the following: value of the land developed.
Okay, thank you very much. So G&M Limited acquired a plot of land developed for what? Industrial use as a factory. Now, we are saying a same factory, okay, similar facilities, okay, a factory with similar facilities have recently been sold for what? 50 million. Okay, 50 million. And we are saying that similar sites nearby have recently been developed for residential use as sites for high-rise apartment buildings. Okay, so with the first one, that one, the market is what determined, or they made reference to what? Recent sales. So that's the 50 million. So the next option is to consider what? The residential use. So Jinyami Limited determines that the land could be developed as a site for residential use at a cost of what? 10 million. Okay, so that's to cover demolition of the factory and legal costs associated with the change of use, because maybe you are having a factory on the land, so you have to do this demolition exercise. You have to change the use of the site. Okay, that one too comes with a legal cost. So that one is the 10 million. Now we are saying after that, the plot of land would then be worth 62 million. Now, highest and best use, you are saying, is that you compare the 50 million, that's the recent sales. Okay, that's the 50 million. Then the value of land as a vacant site for what? Residential use. It is 62 million after what? Demolition and change of use and all that. And that one came with a cost of what? 10 million. So you subtract 10 million from the 62, you get 52. So you compare this one, and we want highest and best use. Therefore, the fair value of the land will be what? 52 million. So there were two options here. First of all, they considered the recent sales, okay, because the first statement you are saying that a factory with similar facilities and assets has recently been sold for 50 million. So that's the first part. And the other option is that they want to develop the land, okay, for residential use. Okay. Now we have factory on the land, so we have to do this demolition exercise and all that. That one came with a cost of 10 million. And after that, the land will be sold at what? 62 million. And that does not mean that you are going to get 62 million in total. The net should be what? 62 minus 10. Then you get 52. So you compare the two, which one is giving the highest? It's obviously this one. And the fair value of the land will be the 52. So please, are you okay with this illustration? Okay, I think
Okay.
we are- yes. So mostly the question comes from this part. The first part here, this principal and most advantageous market here. This is where the question comes from. So you have to understand it. And we have bid or offer prices. Okay, bid or offer prices. Okay, so those of us who did or who wrote financial management, we've heard of this before. So yeah, we are saying for some assets or liabilities, market quotes prices that differ depending on whether the asset is being sold or bought from the market. So your the asset, its price, the quote prices, okay, may differ depending on whether you are selling the asset or you are buying the asset. So the price at which an asset can be sold to the market is called what? The bid price. Okay, it is the amount that the market bids for the asset. So the price at which an asset can be sold is what? The bid price. What about the offer? The price at which an asset can be bought from the market is called what? The ask or offer price. It is the amount that the market asks for the what? Asks for the asset or offers to sell it for. So please, this is just for knowledge sake. Okay, so bid means the selling price. Okay, Bid means the selling price, and offer is what? The buying price. Okay. So you just have to know this. No one is going to ask you the definition of that. All right. So I want us to look at this. March 2025. Yes. So I want us to read this past question, and when we understand this one, we are okay with the standard. We move on. Okay. So please, someone should read. Someone should read this one. So it's a past question. I think how many marks? 5 marks. Yes. March 2025. Okay, so someone should read. Your standards too, Akao. So please let's be fasting. I beg.
Okay, so Jato Autos Limited is a major car distributor in Ghana. DA is currently preparing its financial statement for the year ended 31st August 2024. The company sells cars in 3 different zones across Ghana. At reporting date, DA has a fleet of 3,000 cars, same type, model, and age, for which DA directors would like to estimate their fair value. The board chairperson believes that the fair value should be based on inputs from markets which provides the highest net benefit from car sales. Information above all 3 markets is as follows.
Okay, so before we move on, we are saying that where is it? So these 3 cars, is it identical or similar? Just want us to see something. Oh, before we started, our sister gave us a clear explanation. Okay, she differentiated this identical and similar thing. So I'm asking the 3 cars, are they identical cars or similar cars?
Similar.
Is that
Similar.
okay? Do you have any?
Identical. That's what I
All right. So I think it's identical. Yes, because same type, model, and age. Same type, model, and age. So this one would have been level 1. Okay. So please move on with the table.
Okay, so total market volume, DA sales volume, selling price, transportation cost, and transactional cost. Northern Zone has a total market volume of 6,500 and a sale volume of 960, selling price of 27,000, transport cost of 2,000, and transaction cost of 1,500. Southern Zone has a total
Okay,
market.
so you'll be reading the market volume for us, and the rest, you leave it. We'll come back to it.
Okay,
So
so
just
the
read.
Southern Zone market volume is 9,800, Western Zone 5,000. Required.
Okay.
In line with IFRS 13, fair value measurement. Explain which calculations explain with calculations how much fair value should be placed on the total 300 cost at 31st August 2014, and comment on the correction of the board chairman's opinion.
So first of all, you ask yourself, what was the opinion of the board chairperson? Okay, so he was saying the fair value should be based on input from the market, which provides the highest benefit from car sales. So let's note this one down, the first two lines. After everything, we'll come to it and see if it was correct or something. Now, before you measure, you answer a question like this, don't go straight to answer it because they are saying 5 marks. First of all, you can start by explaining what fair value is. Okay, can start by explaining what fair value is. You can now talk about what the types of market. So you can state the principal market, or principal market is the market with what the greatest volume and level of activity. And then you can also talk about what the most advantageous market, the market that gives what the highest benefits. Okay, the market that gives the highest benefits. Okay, you can also talk about how you determine the most advantageous market, or how you're going to determine the principal market. The principal market, you already believe that the market with the what, greatest volume and level of activity. Okay, you can also talk about what transportation cost is, what transaction cost is. Then you talk about the use of this transaction cost, whether it's going to be considered or you're not going to consider it at all. Those things. So you have to be writing certain things. Don't just go straight to determine the fair value. Near amount 5 marks. Okay. So with this one, the standard. Okay. So this one you can say it in the in your answer. You are saying the standard only permit the principal market. Only if you have principal market in your question, you use principal market. In the absence, it's what? In the absence of principal market, that's where you make reference to what? The most advantageous market. One may ask, do you have a principal market in this particular question? Let's take our time to analyze this question. This question, if you understand the standard, it shouldn't take more than even 3 minutes in answering this question. Get your 5 marks. Rebecca said pressure, but so do you have a principal market here? Hello. Hey, Obiangasa. Oh, this your thing there. It's not nice crowd.
Yeah, pa. What's the question again?
The principal market would be the southern zone.
Southern zone.
Yes.
Okay. Yes, you are correct. Because that is the market with what? The greatest volume. Okay. Because if you look at the definition for principal market, we are saying where is it? It's the market with the greatest volume and level of activity for the asset or liability. So southern zone. Southern zone. So please, you all agree?
Yes, please.
Okay. So southern zone will be your principal market. So please, someone should determine the fair value for this market. Someone should determine the fair value for this market. So we are saying southern zone is the principal market. So please, who can determine the fair value for this type of market?
The fair
Just
value
mention.
is
24,900.
24,900.
And so please, how do you arrive at that?
So the selling price less the transportation cost.
So selling price.
The selling price of 28,000. Then we have the transportation cost of 3,100.
Thank you very much. Okay. So our fair value will be what?
24,900.
Please, do you all agree with her?
Yes, please.
Okay. Okay. Now, one will also say that, oh, but if you look at the sales volume, Southern Zone is having the least one because they make sales of 960 in Northern Zone, 800 in Western Zone, 608 in what? How do you call it? Southern Zone. So Southern Zone is the zone that they make or the lowest sales. But the standard is saying where you have principal market, you shouldn't fall onto what? The most advantageous market. Therefore, the value, the fair value that will be placed on the 300 cars will be 24,900 because we have a principal market. Maybe if they didn't give us any volume, okay, the total market volume to determine which market is the principal. Okay. Maybe they didn't give any clue, say northern, southern, or western zones is the what principal. That one, we know that we have no clue in determining the principal market. Therefore, we have no option to use the most advantageous market. Okay, we have no option to use the most advantageous market. So with this one, you can only place 24,900 per a vehicle, okay, per vehicle. So as at 31st August, 2024, the fair value to be placed on trainer cars will be 24,900 times 300 cars. So please, what is the total amount?
74,70,000.
74,70.
So the zero will be 3. Yeah.
Okay, so million.
Yeah.
All right. So this is how you answer it. You can also 5 marks. So you can also talk about what the most advantageous market. But we all know that we have principal, so this is the value you use. But to get more marks, you can talk about what the most advantageous market. So please, with this same question, we are doing our
Wait,
own
hello,
thing.
Pa.
Hello, madam.
Yes, so you use the selling price. Then we
Mhm.
subtracted the transactional cost. So the
Transport
total
cost.
transport cost. Then after that, you multiply the fair value by the.
Trainer cars. You said trainer cars here.
So the total market value was just used to determine the is it the advantageous market or the principal market?
Come again with your question, please.
So the total market volume, it was
This
used to
one.
determine the principal market.
Yes, yes. Which market is the principal? Because if you look
Okay,
at the definition, we are saying where the principal market is what the greatest volume and level of activity. So before we even started all of this, I said the market with what the greatest number of units. So I made illustrations here. I said market one is having 1,000 units, market two is having 800 units. Market one is having what the greatest number of units. That's 1,000. That one becomes what principal. Yes. So the total volume here was used to determine which market is the principal. In the absence of this, and if you don't have any clue, then you fall onto what the most advantageous market. Yeah, so it was used to determine which market is what? The principal. So please, are you okay?
Yes, please. What about the sales volume? That one, we don't use it for anything.
No, that one you know use it. That one will be okay. So we come to that place because the director said we should fall on a market that provide the highest benefit from what? Car sales. Okay, so he is talking about the most advantageous market. So the sales volume is just to tell you which market or which zone that they mostly make their sales. Are you okay?
Oh, okay.
Yes, please.
Yeah.
So
So hello, senior.
I was thinking, actually, earlier indicated that will help us to identify the most advantageous markets,
Mm-hmm.
the sales volume,
Yes.
or
You are saying it will help us.
to identify the most advantageous market.
Yes, you can use that one, okay. But someone can also use the method that we used here. The method that we used in this particular illustration. You have to consider transaction cost this time to determine which market is the most advantageous, which market gives the highest benefit. So to do that, you take all the three um, markets, okay, or the zone. You take all of them. Then you do selling price minus transportation minus transaction. You do all of them. Which one will give the highest? That one will be the most advantageous. You cannot simply look at this one to say it. So you just do it to confirm it. I hope you get what I'm trying to say.
Yeah, I guess you.
Yes. So the selling price. So please, what is the most advantageous market here?
I mean,
Nothing.
Northern zone will be the most advantageous market. That's what you are saying.
Yes, please. Hey. Yes.
Okay, so let's all do it. So I'll just replace them there by their initials. So
yeah,
Northern zone. Okay, have you all confirmed? Or you let's do it. So NSW. So this is Northern, Southern, Western. Now let's look at the selling price. For this is 27,000. Southern is what? 28. Western is 25,000. We are determining which market is what most advantageous. So this time around, you consider transaction and transport cost. But when you are measuring the fair value, that is where you will not consider the transaction cost. Okay. So first of all, transportation. It is 2,000 for N, 3,001 for S. Then we have 2,005 for W. Then we come to a transaction. You will only consider this one to determine which market is what the most advantageous. So with this one to we start 1,005, 1,009, then 2,500. So please let's determine the net amount received.
23,500.
23,500 for Northern Zone. Southern.
23,000.
And 20,000.
23,000.
And 20,000, right?
Yeah.
So you do this just to determine which market is the most advantageous. So which market is the most advantageous?
Northern zone.
Okay, so OJ, if you want to look at the sales volume, you see this one was 960, that's the highest. Good. But what if the selling prices will result in something else? Because this one is sold at what? 27,000. This one is 28. This one is 25. So your analysis will stand where the selling price and everything remains constant. I hope you get me.
Yep.
Because what if this one is 960? That's the highest sales volume. I understand. This one is 60 is the least. But what if this one, the selling price is 35,000? It could result as the highest net amount received. So always do this simple calculation to determine which one is the most advantageous. Don't just look at the sales volume, although the sales volume is a key factor, but still move on to confirm. Okay. So the fair value under this market will be what? I want to see something. What will be the fair value under the most advantageous market? Yes.
Fair value.
$25,500. The
Z
Value will be 25,000.
500.
Yeah,
25,000.
5,000.
so the fair value will be the 27,000 minus what? 2,000. That one will give you 25,000. And this one gives us the highest benefit because this one is 25,000, this one is 24,900. But they can only use this method or this fair value if they cannot assess the principal market or they cannot determine what market is the principal. Okay, but with this, it was clear that the southern zone is the principal market. Therefore, the fair value to be used is what? 24,900. And you have to comment on the correctness of the board chairman's opinion. Therefore, the board chairman's opinion is wrong because he is saying that they should fall on the market which provide the highest net benefit from car sales. They would have used the 25,000. That is his opinion. But the standard is saying that where you have principal market, you use principal market. In the absence of principal market, you fall onto what? Most advantageous market. Therefore, the board chairman opinion is wrong. So please, are you okay with this question?
Yes, please.
Net in 5 marks. So please, this is the end of fair value measurement. Fair value, and when and I send the notice 25 times here. Our amount is here. Okay. So please, do you have any question for me? Hello.
Not on my side.
Okay. Okay, so we'll continue this time around. We want to continue with the recording. Okay. So IFRS 8 operating what segment?
Why don't we stop it? Or
No, I think it's okay here like this.
okay.
If you stop it, at least we know that this one is for the scenario, which makes it easier for us to read.
Okay.